Welcome to iGlobal Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration. Hello everyone, my name is Rob Clayton and thank you very much for joining me. Since the Australian dollar recaptured its bullish stride 48 hours ago, the market, since clearing 77 cents, has pressured the upside, but in the last 24 hours hasn't made any significant moves, considering the recent global headlines that's been hitting the market. Over the night, firstly, was the release of the minutes from the Federal Open Market Committee, which still at this point remains somewhat hawkish. From the notes, all members agreed that raising rates gradually was seen appropriate and that they were remaining upbeat on the economic outlook. Secondly, the market shrugged off the current tension from the US and Russia after President Trump said in a tweet that Russia vows to shoot down any and all missiles fired at Syria. Get ready, Russia, because they will be coming nice and new and smart. His tweet went on to say, "You shouldn't be partners with a gas-killing animal who kills his people and enjoys it." From the reaction, the market did rally in the commodity sector and also in the stock market, but not so much with the US dollar nor with the Australian dollar. On the day, the market trades at 77.25 to 90, and any advantage should still be seen as a sell opportunity. Well, the euro didn't make any significant moves, considering the dollar index is still trading moderately sideways. Yesterday's close was 89.26. Today's close is 89.16. Overnight, the US data release revealed that the core US CPI rose by 2.1% year-on-year in March, the largest since February 2017, improving by 1.8% rise in February. Concerns remain to the low US dollar at present, and with the broad uptrend seen on the monthly graph for the DXY at 88, the market now needs to recover very, very soon. Otherwise, concerns will be turning back to a bearish US and a broader, stronger euro. But at present, I still hold the view that the market should eventually stay above that broad uptrend and see the euro fail towards the region of 124 to 124.5 and look back to the downside with the intraday support at 123.35 to 122.70. What was disappointing is the dollar yen. After the last 5 days, the market is sliding lower and back underneath 107. Now, from the technical outlook, the technicals, as you can see, are breaking down from the stochastic, slightly from the MACD as well as the RSI. The immediate target at present is at 106.55. Now, a break beneath there would give further concerns and stops to trigger to a move of 105.65 and reassess from there. Resistance on the day, 107.35. Well, the pound nudged higher overnight and mainly on the back of some data that was released. The economic data that the British manufacturing production was a little bit disappointing after the minus 0.2% decline, missing the estimate of positive 0.2. The previous was 0.0. Britain's trade deficit narrowed slightly by negative 10.2 billion, beating the forecast of 12 billion. This marked the lowest deficit since October 2016. Ahead, though, to come is the Bank of England, which does likely to expect a hike in May, especially when Bank of England Ian McCafferty urged the bank not to delay in raising rates, along with the policymakers also supporting this view. What is in favour of a rate hike is that inflation remains above 3%, well above the 2% target. As all things stand, it is likely to see a 25 basis point hike in the pound, therefore could keep this market in a slightly bullish tone. Now, if you notice that the uptrend has risen from the low 139 to nearly 140 now. I do expect to see any weakness towards this region as a buy, and we could see further gains, but would need to clear a break of 142.50.90. Well, as I mentioned about the geopolitical concerns, gold rallied 27 points overnight from 38 to 65, spiking at the recent highs that we saw in January and also in February. However, from what can be ascertained is that the rejection from that level may be back to the top side of this range. And as I've been going on, is that we're still in a 1300 to 1360.65 range. And this time around, the market's reached its upside objective. If we do see weakness and a break under 48, then this would give further concerns down towards 42 to 36 as a potential target. Until we clear 1365, then I would say this is at present top side of the range. And also, if you note, the RSI has actually confirmed a rejection. And rounding off with silver and oil. Well, oil spiked back towards the top side of the range, around $67 a barrel, after it did print a 4-month high. Sorry, it did print a high of December high of 2014, which was at 67.36. Overall, the geopolitical tension that does come back into play could see further gains if we close above this level 66 and see a rally on towards $72 a barrel. So do be a little bit cautious in how you'll trade this. This market is traveling on fear at the moment, not so much as a technical, purely for the fact is with the tweets we keep getting from Trump that are targeting Russia at the moment over the Syria tension. Well, that wraps up for today. Thank you very much for joining me. And as always, look out for the intraday report that will release shortly.